Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending May 11th, 2018. Well, is the glass half full or is the glass half empty? This week it was half full. We've seen the Dow move up 2.34%. S&P is up a little bit more, about 2.4, and the Nasdaq was up even more, up about 2.68%. Meanwhile, obviously with the moves higher, and the breakout to the upside of the downsloping trend line, which I'll talk about in just a minute, we see the VIX move down. This week it's moved down to 1477. I'm sorry, 12.65 from 1477. In the prior week to that, it was at 16.77. So over about a 14-day period, we've seen this VIX slowly back off from about 16.7 down to about 12.6. So we're getting into the range that we were at, or the upper end, slightly outside the upper end of the range that we were in for almost all of 2017. But remember, when we have a volatility event like we had in late January, early February, the volatility gauge, the VIX, tends to be more sensitive to any downside move. So should we get a 20, 30 point move to the downside over a day or two, we'll see the VIX react a little bit more aggressively to the upside than we saw with a given similar move last year, although there weren't that many moves last year of the S&P moving down 20 to 30 points over a short period of time. Even when we got those in 2017, the VIX barely moved off of its 9 or 10 lows. But this year, it's a little bit different. Volatility is a little bit more sensitive to any downside movement. So that's kind of where we're sitting. And so the market is really interpreting the price action, and big money is interpreting the price action as clearly bullish. Now, this past week, we've touched and moved slightly below and above the 200 EMA. If you convert it to a simple moving average, we were just slightly on it. But on an exponential moving average, the 200 EMA has held up very well. And you can see on this chart here, which is the yellow line of the 200 EMA, where price action has moved off of it several times. Now, granted, it's moved below it during the course of a trading day, but there's only been one day where we've closed below the 200 EMA. And that was back on April the 2nd. And then the very next day, we moved back up above again. Now, on end of March, third week in March, we actually we closed on the 200 EMA, but then you can see we moved up above and then back below. And now we're off and, excuse me, we're off and running again. And then you can see the 50 EMA, which is the red line on the chart. We broke out not only above that, but we had some strong overhead resistance that was overcome. If I were just to blow it up, just so that you could really see it here on this chart, you can see here that the red line is the 50 EMA, the downsloping green line, which forms the top part of a symmetrical triangle, and then the blue dash line, which is the 2018 open price. So we accomplished a lot of things. You could see for over almost 2 weeks, 2018 open price held us up. We would move up above it intraday and close below it. We could not break it. And then finally, this past week on Wednesday, we broke May the 9th, we broke the 2018, and then we held it. And then we took out a prior pivot high, an all-important prior pivot high. And now we're in what I call our R1 resistance zone right here, because there's some other price points up here that we ran into difficulty. So if we can move beyond this resistance zone, which has got the north side of it around the 2730 area, then we're going to move up to the next pivot high, which is right up in this area here around 2789. So we're off and running. Now, inevitably, when we take out a pivot point like we took this one out right here, we can expect and look for a test of that prior resistance point. Okay, so before, this whole zone here is a resistance zone. You know, inevitably, a lot of technicians try and get it so precise because human nature tends to love precision. That's why mathematics and folks that excel in mathematics and quantitative analysis love the precise nature of it. You know, the resistance point is 2789.75. But then you throw in human nature, you throw in fear and greed, and as you always know, or you should know if you're trading the markets, is you always have under and overshoots. So I like to put in zones here that just kind of show where we can expect price action to just find a little bit of resistance before moving higher. And if we blow through it, then in this particular case here, approaching from the bottom up as a resistance point, if we move up above, we should expect there's more than a 60% probability that we can come back and expect a retest here. Okay, so that is kind of where we're sitting here on this chart. And you can see here on this daily going back to really going back about 3 months, we've got a little bit of a volume over price area here. Now, if I were to just move it into almost exactly 1 year, just so that you can get it down here, right? So if I can come in and just put in 1 year, let's just let's zoom out so we can get right at that area there. So you can see the volume over price here based on 1 year, right? And they're right in this zone right here is this volume over price. And then once we blow through it, there's not a lot of volume over price at 27.89, and it dissipates. Right there is a little bit, not much, but there's a little bit of a zone here, and then there's a little bit more of a zone right up here before we broach the Netherlands and get into dry powder up here at 28.78. So my opinion in looking at this chart near time is a couple of things happened over this past week. And let me just blow them up and I'll show them to you. Number one, we had a change in the vector of the key moving averages. All right, what do I mean by that? Well, the 200 EMA has always had a slightly upward vector to it. As I draw the arrow on this, you can see that the upward vector is moving up ever so slightly. The vector is moving up just a little bit to the nth degree. The 50 EMA had a very horrible downward vector, and then it slightly moved up, and then it started moving back down again, right? So as I connect these dots, you can see the downward vector in the 50 EMA. Now, if I were to connect the endpoint right there, it is slightly skewed to the upside. If I were to draw an extension of the current vector, that's how it would look, right? Something like that. So that movement there shows that clearly we've resumed our slight cant to the upside, a slight bullish bearish. Now it's supported by a cross in the MACD below moving up like that. And it's supported by this right here, taking out that prior pivot high here, okay? So that is where I'm interpreting the chart thus far. So right now, all things being equal, we can expect the markets to grind a little bit higher. Okay, I mean, that's just kind of what I would expect right here, unless we have a geopolitical event that can stop that. And there are many that are out there. We've got the U.S. backing away from the Iran deal, which jacks the price of oil. We got Iran from Syria using as Syria using as a base, lobbing things into Israel. Israel retaliates. I can't talk this morning, guys. Retaliates. So we've got a lot of that going out. Meanwhile, we've got good news on the North Korean or the Korean Peninsula, where we've got the hostages released and we're moving forward there. So 2017 was less volatile on the geopolitical front, and it's really come to bear here in 2018. So those are the only things. I call them my 5 T's to risk analysis in the markets. You know, the tariffs, technology, tightening, and then the Trump tweets. Okay. And we saw a mass exodus from technology in late January, February, and we're now slowly building it back. So this is kind of where we're sitting right now in the markets. Okay. I do believe we can, if we clear this zone here, the momentum suggests that we can, but I would expect a little bit of choppiness here, slight grind. And this coming week, you know, we're winding down earnings. Earnings have been very strong for Q1. I mean, we've seen a 20% growth in profit expectations for 2018 versus 2017. And not only are bottom line earnings per share numbers being beat, but so are top line. Tax cuts to corporations have allowed them to free up more capital to increase their dividends, do share buybacks. I think there's over 650 billion um, estimated for 2018 of share buyback. That'll be the highest on record. And Apple obviously is contributing more than 10% of that. They came out in their earnings and said they're going to buy back 100 billion shares to the tune of 20 billion a quarter. So that's one way to drive earnings per share up. Okay, so it could be that Apple is moving away from a growth company and moving into a value stage. We'll see. But it could be also the first company that can hit $1 trillion in valuation. So this is where we're sitting right now in the markets. And if we look at the transports, one of the things I like to do is just see the strength of the transports. Um, and obviously I can't spell either, so I can't talk and I can't spell. You can tell I'm a former Marine. Oh my God. So, but you can see here with transports, we've had a good strong run in May. And I'd like to see transports come out and take out the prior pivot highs. Because if we look at the Dow Jones, right, transports are a good canary in the coal mine for the markets. If they're showing strength, and then if we can get strength in the Dow, let me just see if I can switch it over to the Dow Cash Index. Maybe I can get something there. Maybe it's not giving me something here. So let me just freeze my screen for 1 second here during the presentation, and then let me just do all of this stuff here, and then just move it off, and then move it back on again. So let's bring it back up on the screen for you guys, just so that we can get the screen back up. I had to reset my eSignal platform here. I think it froze up on me. I've got so many applications open right now that things are bouncing around on me. So I just had to shut it down and open it back up. So let me get it back up on the screen here. And let me get the Dow futures up, and then I'll get the screen up for you guys so that you can see the Dow futures. But I showed you before the transports. All right, so let's get the screen back up for you so at least you can see something. All right, so now you can see on this screen right here the Dow or the Dow futures, and you can see on the futures we just moved into the green on Friday, and we're just now challenging this pivot point right here. So the Dow is lagging behind everybody else, all right, primarily because of the tariff talks, because tariffs will hurt the Dow more than anything. If we look at the Russell futures, you can see the RUT futures are almost near their 2018 all-time highs, by the way, 2018 highs, 2018 all-time highs. And we're challenging the prior, not that we've already taken out the prior pivot high, but we're challenging the pivot high before that. So in many respects, the Russell futures, small cap, has got the strongest chart of all of them, primarily because it's small and mid cap. So money has been flowing into small and mid cap. They're catching up because it was lagging behind for all of 2017 until we had that big move down, and then starting in early or mid-March, small cap has been catching up. For our members, we knew this because I was showing you some charts that I use to track ratios between small cap and large cap, and you could see here where we've seen this catching up. Okay, so it's really making a dramatic move higher. And then, of course, if we look at NASDAQ, the other one, you can see NASDAQ, it just took out the prior pivot high, but it's well off of the highs here compared to the other charts. Okay, now I was watching NASDAQ to see if we would set up for a head and shoulders. And right now, this is also another confirmation that the markets just do not want to give it up yet, right? So you can see here that pattern, and then once we took out that prior pivot high, it kind of screws up the right shoulder of a head and shoulders pattern. So now that pattern, you can just pretty much throw it away. Clearly, that's a strong support point or a neckline in the head and shoulders pattern, but that is now out the window. And we got to approach it from a bottom-up perspective, which means we now have to look at it, and we got to say, without that head and shoulders pattern, you know, where can we go from here? And obviously, looking at the chart, you can see here that once we take out what was formerly the left shoulder pivot point high. I think we're going to challenge that, and then we can move up and make new 2018 highs. Notice the NASDAQ was the only index that made new highs in March. All the other indexes, their highs were made in January. NASDAQ made new highs in March, which led me to believe that we're not done yet with moving higher. We needed to flush out a lot of weak hands in the market, but we're not done yet. Okay, even the NASDAQ in early April moved into the red for just a very brief period of time, right? It came close to the lows that we made in early February. But everything is right now telling me and suggesting to me that we should run higher, okay? If we come back and we look at the SPX, which is the cash index, it doesn't obviously trade in overnight hours. You can see here with the SPX, and if I were to just kind of take everything off the screen here, you can see here, backing it out. And let's just really back it out a little bit further. Okay. And what you'll see that I've got on the screen here is going all the way back to the Trump election. So I've put a fib node on the SPX cash index from when Trump was elected or the night before he was elected, because the SPX doesn't trade in overnight. If you look at the E-minis, you can see how the E-minis bottomed out the night of the Trump election around 2 in the morning, and then when he was confirmed, all of a sudden it's just been, just batshit crazy to the upside with a few down moves. So now, from the Trump election, because this represented, and the reason why I chose the Trump election, it's not more so from a technical perspective, but from a change in geopolitical politics, and it should serve you well. So you can see here on my fib nodes right here, where we've had this strong move up, right? And if I were to connect the dots like that, and obviously I didn't connect them very well, but we're still underneath this vector, this upward vector that we've had really until we came down and just blew up at the end of January, right in that area there. Okay, so I do believe we're going to come up and challenge that area again, which is just south of the prior pivot high. Okay, but nonetheless, with none of these pullbacks from the high in January came down below the 38th percentile range, which is a very common pullback point on fib nodes for those of you that really understand Fibonacci. In fact, a pullback to the 50% is also very popular, which would take us down to 2478. And we never did get there because the Trump administration is really juicing the economy. All right. So for 2018, I don't see a recession coming anywhere near. I just don't see it. I do see, however, and I'm sticking to my forecast of going into a bear market recession first, then bear market sometime in middle to late 2019, going into 2020, and it's going to get ugly. All right. So that's kind of where I'm what I'm looking at right now. Okay, so this is the cash index. Now, if we come out and we look at volatility and the VIX, and this is a daily chart. Now, you'll notice that I've color coded my chart with the VIX, and it basically just shows you the various zones that I have. And depending on what zone you're in, it's just real quick for me to look at it because I go at different time frames. And the zones stay the same, just kind of where I am with the zones and different option strategies and ways to approach the market, especially from a hedging perspective. Okay, so you guys can just see what I use. And I've been using this for quite some time, and it works out fairly well. Some people don't color, they just know in their mind when VIX gets over a certain level that you can just fundamentally or intuitively know. But you can see where we've been and where we're going, right? So if I take the VIX and put it on a 2-hour time frame, and then we just zoom in on this thing, right? We'll just kind of look in. You can see we're now back down, which is below 15 in the VIX. We're in the green zone, which suggests vol is relatively low. We got to be careful with a lot of credit spread type strategies or strategies where we're selling puts because in the SPX index, you can find stocks that make sense, but you just have to be careful. And I'm not saying that you don't want to do it, especially for those of you that have portfolio margin. You just have to be very careful. Okay, you do not want to be in abundance in this because the volatility is more sensitive this year to a downside movement than it was in 2017. So we can expect a lot of spikes. As you can see in this 2 hour chart, even this 2 hour chart going back 3 or 4 weeks, you can see when it spikes up. I mean, each of these spikes, the VIX runs up, 4 or 5 points inside of a day or two, and that's it's going to be like this for a while until things settle down. Okay. So that's a little bit about what I've got going on right there. And then the other thing we're looking at is if you look at the bond market, the bond market's going to surprise people. All right. I've said this many, many times. It always seems to, but the bond money, big money, I call it smart money. You can see we came down and almost hit my target perfectly. And this suggests that I don't see interest rates going much higher, meaning bonds much lower right now. As long as Europe and Japan continue with their stimulus ways, which they are, and they got dovish people running them, then there's going to be a bid in the bond prices because you got money coming in from Europe and Japan buying our bonds. And when they buy our bonds, that drives interest rates down and bonds higher. So it's providing a little bit of a floor for us in the bond market. Okay. And you can see this poor man's butt. Our members know what I mean when I say that, but that basically suggests that we can have these ABC chop patterns around the low. We came down and almost hit my target was right at about 141, even 140 and 30 ticks, but roughly about 141 area. And we came down and hit 141, 17 ticks. So we came down very close to my target, which I had on here throughout most of this year. And that's kind of where we're sitting right now in the bond market. And you can see with interest rates, and look at the 10-year, it came up and hit my target almost to the T. I missed it by 1,000%. So we're now sitting on the 10-year interest rates at 2.971. Okay, so that's kind of where we're sitting here. And we're in this resistance zone here. And we've got a 3, 4, 5 pattern, just like the bonds, only it's the mirror image opposite. We got a poor man beds on here. So you folks, you members know what that means. So we're going to be in this choppy mode here for a while. All right, so I am not all, gung-ho on shorting bonds right now. You got to be careful. When bonds are ready to break, we'll know it. And part of it's going to be geopolitical. Part of it's going to be fiscal policies by Europe and Japan, not as much the U.S. Okay, so this is kind of where we're sitting because it's a global market now and money seeks safety. And right now, the bond market and the U.S. debt is where it's at. The yield spread between the British and the German Bund and the British gilt is at highs I haven't seen in quite some time. Over 270 basis point spread, credit spread between theirs and ours. So that's going to keep money coming over here, right? So that's where we are right now in the interest rate market. If we come down here and look at currencies, look at what the dollar did, everybody. I told you this was going to do this. We've seen this dollar bill, this base right here. And it's a little bit more of a solid base than before, all right? Right in this area here, I took a dollar long and I said in this area here, it didn't really have a chance to build a base. I mean, we just went down and then we started bouncing up and it didn't get very far and it formed a really key pivot point right in this area right here. And I've already extended out. That's a very strong pivot point right around 95 on the dollar index. And then we gave it all up, came down, almost came up and hit it. And then we worked our way down and we formed 2018 lows. In fact, I had a target down here, the dollar index of about 87.50. We hit 88.15. But I said, notice here, this downward stroke is a little bit different. We built this long base. So now we're kind of moving up, kind of do one of these things, and we could come up here like this and break out here, but the actual breakout is going to be down in this area down here. The typical breakout runs about 10% in kind of this cup and saucer type of pattern. Now, are we going to get here? I'm not really sure just yet. I mean, that's the way the pattern is setting up, but I'd like to see a little bit of a pullback here, forming the handle of a cup and saucer, and then I want to see buyers step back in and take out that pivot here. Remember, this pattern hadn't formed until we have this handle part of the cup, and then it breaks out of that handle, and then you got a 10% move to the upside, which would put us up in this area right here. And you can see this volume over price. If I were to extend it all the way out, that is the measuring objective. There are a couple of small ones right here, and then a really big one right here, which is kind of where we're sitting right now. You can see that elevation in the MACD, so I would not be surprised to see it come down and then make another run up. So that is playing out according to our script. Okay, so folks that are following us in that one, you know, it's really good. Now we're taking a contra trade move right now in the euro. And for those of you that aren't members, I highly encourage you to come in and sign up. We got a pretty good growing international audience all the way from, we got a lot of members surprisingly in Singapore, over in the Asia Pacific area, Hong Kong, Japan, got some in Australia, New Zealand, as well as the US, North American, Latin American, and European markets. So because we trade a number of different commodities that affect it, as well as currencies, as well as equities, mostly US equities, however. But you can see on this dollar index where all the major areas of support and resistance are. We are now in this resistance zone right up here around 93.45 with that volume over price. But we formed that long base and it broke out. And I said, if we do break out, you want to be long the dollar or short the euro, or you can be short euro dollar in the Forex market. And that's kind of how it's played out. So it's been playing out according to what I've said here. Now, let's go look at the British pound. This is another one that we were talking about for quite some time. Down here off the Brexit lows, I said the British pound is going to be a great trade. Forget what you read in the press. Forget what these knuckleheads are saying. It's going to be a nice long run. I said it's going to be a very wide channel, and as it started moving and formed the channel, remember when you first start, you don't know if it's going to be a channel or not. But after it had been in it for, I would say, 4 or 5 months, we formed this channel. I said we want to be sellers once it gets to the top of the channel and buyers once we get to the bottom of the channel. And then obviously up in these areas here, you don't want to buy, even though I'm long the British pound longer term. And then we got up here. Now we're back down to where we're getting to a point that makes sense for buys for me in the euro. I mean, in the British pound. And I believe this can move up and challenge these pivot points up in this area here around the 143 area. We're down around 135 now. So these are just some trades that I'm looking at in the currency market that have been, from our macro view, have been performing very nicely. Okay. Now, if we come down and look at gold, what can I say about gold, guys? It's in a range, and it's been in this range for quite some time. Notice I left up here on purpose the 2016, 17, and 18 all-time highs, or highs for these years, rather. There's a ton of resistance up in this level. And you can see for this year, we started the year right here, okay? So this is 2018, right at the beginning right here. And we've just traded in this very choppy range. Gold tends to be a very technical instrument to trade, meaning it tends to trade the technical patterns very well. So that is the range that we've been in, high to low for this year. And you can see right below it, I've got a zone that sits right around 1300. So going back in time, that is when buyers tend to come in. And when we get to the upper area, sellers tend to come in. And we're in the lower quartile of this zone right now, which suggests after that move down, we could possibly stay down here or come down and retest this again. The trade for gold right now is a range-bound trade where you're in the futures market and you're selling calls. Maybe you're doing a call credit spread, or you're down in this area. You want to be below 1275, 1280. In fact, if you can help it, and you can get it in the futures market, you want to be below a 1240 strike, okay? And then you want to be, short puts and then long puts to hedge your short put. And you can set this up, obviously, as an iron condor. And for the entire year of 2018, you would be fine, okay? And the reason why the puts are this far out of the money is if we break the 1300 level, gold's going to fall down to the 1280, 1275 area very quickly. There are a lot of algos that know that level, and it'll kick off in a hurry. For those of you day traders, that would just, you could put some contingent sell orders in, a contingent sell order at like 1295. Now, And I'm guaranteed there's probably a lot of them in here, right? Now, you may have some algos fire down, trip it, and then move back up again. So you just need to watch it very closely. But if it gets down in that area, gold's going to have a tendency to move down to about the 1280, 1275, a possible retest. And if that retest fails and it comes down, then we're coming down to the 1250 area. That's going to be some great trading for those of you that like to day trade or swing trade gold futures. So we're going to be watching that very carefully. For those in the option market, setting up short call credit spreads or bull put spreads with puts right now seem to work out very well. Understand in the gold market, the margin requirements are slightly higher than they are in the oil markets. Okay. And in the oil markets, you can see here, oil came in a little bit, but all that is we hit my resistance point was sitting right at 71.80, right at 71.84. What did we hit? 71.89. Now, and if you look at the MACD here, there's near-term bed, further term poor man's bed. So that suggests we can pull back just a little bit and kind of catch our breath. There are a lot of weak hands holding long gold right now, and in the Commitment of Traders report, there's an overabundance of longs, which means any pullback, some of those longs are going to start taking profits, which will beget more selling, which will beget lower prices, which will beget more selling until we find buyers willing to step in. And that area is right around the 66, 66 area, kind of an ominous number. But that's where I would see near-term support holding up, firming up for us. Now, oil reminds me of the movie Trading Places. If we go back, and I don't know how far back this will go, but let me just see if I can put it on a weekly chart here. And let's go back to, I think my limit is the year 2000. Okay, so the year 2000 right here. You can see, and in the year 2000, oil was at 2002, oil futures were down around $20 a barrel. Okay. But if we look at oil and where it's been, this is huge fluctuations, guys. We've gone from $20 a barrel in the year 2000 to right up here to about almost $148, $150 a barrel in the year 2008. And then we came right back down again. By the way, this was the best trade of my lifetime. I was short oil futures. And then we came right back down here to around $33 a barrel in 2009. Then we came back up to about 114 a barrel in 2011. Then we came back down to this level down here around 33 a barrel in 2016. And now we're back up to 71 a barrel. All right. So all I got to say with oil is if you don't like the price, just kind of stand by and wait because it's going to change on you. But it reminds me of that movie Trading Places where at the end of the movie, Billy Ray Valentine is asked, do you want cracked crab or lobster? And he basically says, well, why can't we have both? And over the next 3 years, in looking at the analyst reports of oil, I think it seems to be that's the answer. Why can't we have both? Meaning we can have high oil. I've seen analysts forecasting oil up to $100 a barrel, and I've seen other analysts coming out and saying oil is going to go back down in the low 40s. And it doesn't mean that we can't see both again. With the advent of shale, now remember in the year 2000 when oil was down around $20 a barrel, we didn't have shale or fracking. And now that we've got that and OPEC is no longer as big of a driver as before, we're seeing a lot more fluctuation in the oil markets, which is good for short-term traders. So if I go back to the daily chart again, all right, and remember, we had 22 out of 22 successful trades in oil, and then we got out of it in February and March because it just got too volatile with our strategies, and now we're getting back into them again. I can see here a little bit more of an upside, but not a lot, okay, because I've got to clear the 72 barrel hurdle is going to be very tough. All right, I think it's going to be very tough. And then you can see I've got another wider support zone that runs up to about anywhere from $78 to $81 a barrel. Okay. I don't see us getting there short of a war between Israel and Iran. So there's still a fear premium in the price of oil, anywhere from $3 to $5 a barrel. So a normalized oil rate right now, based on supply and demand, would put us around the 65, mid 60s area, roughly. And a lot of this is fear premium. So just understand that about oil. And the U.S. now, our imports of oil have dropped by over almost 70%, because we're meeting most of our oil uh, needs right now and energy demands right now with shale and fracking. And then with the advent of more electrical cars and energy substitutes, green energy, you're going to see oil start to get a lot more flexible, variable in price, depending on what OPEC wants to do. And Saudis, they're trying to take Aramco public this year or next, and the higher the oil prices, it's in their best interest near term to run it up. But they don't want to run it up too much, because then they lose market share to the shale frackers. So these competing dynamics make oil short term a real interesting trade for oil futures traders, as well as some of the things that we've been doing. So that's kind of my short-term take on oil. Again, for our members, we put on a new trade in oil this past week, and we're going to be taking one off in another couple of weeks and looking at playing some more. So, and then the other thing that we've got is, if we look at corn, we've got a trade going on in the corn market right now. We hit a high up here of 408 and 2/8, but I believe we're going to come down and find some support around the low 390s and then chop around here for a bit. We've got a poor man bed on this right here, and we're getting this fire off here, so that just means an ABC pattern near term until we work out the directional bias. Longer term, I think corn is going to move much higher. If we step it out to a weekly chart, here, and then if I were to let me just see if I can't take a lot of this off the screen. You can see on the weekly chart here, like the US dollar, we've been building a very, very long base. All right. When this thing breaks out, it's going to run technically up to about the 520 area very quickly. All right. And then it'll probably consolidate up here before we move higher. But that's kind of what I'm looking at corn. Soybeans and wheat, very similar patterns. So we've got some trades on now that are running for us in our group. So that's where we're sitting right now, folks. For those of you that are members, I will see you this Sunday evening for our weekly market watch. For those others that are non-members, I highly encourage you, as I say, to come in. We've also running our option masters, which is really popular. We got a lot of folks coming into that course. It's a master session on options and option strategies. We're covering everything. So I invite you guys to participate. Otherwise, have a great weekend, everybody. I'll see members. I'll see you guys this Sunday evening. Take care, folks. Ciao.